for joining me on my weekly session. This Thursday, we will be talking to Ruben Crispino, Intergalactic Manager for the Prime Group at CMG Home Group. And we're going to be talking about something that, I never thought of was a thing, but apparently it is, which is reverse mortgage purchases. How to take advantage of a reverse mortgage to purchase a home. So, Ruben, welcome. Thank you for joining us this morning. I know that you were out in the cold of, was it Tennessee?
It was Tennessee. It was Nashville, Tennessee, and it was cold. I had to buy a jacket and everything because, I'm used to going to work in flip-flops most of the time. So definitely a change for us.
No cowboy boots? Were you wearing the cowboy boots and the 10-gallon hat and the whole thing?
There's a picture of me with a cowboy hat, and I look like a Guajiro. So,
You look like a Guajiro. You don't look like a cowboy.
No,
Okay.
no,
All right.
no. I don't look like Rip from Yellowstone. Trust me.
No. All right. So, Ruben, we were going to chat today about HECM, which is the abbreviation for a reverse mortgage purchase, right?
That is correct. There's a lot of fun stuff happening with that, right? So just to kind of give you a little background on mortgages and reverse mortgages, specifically a regular mortgage that we're used to, a conventional 30-year mortgage, we just call them a mortgage, but the true name is a forward mortgage, okay? So today we're going to talk about reverse mortgages, and that's how the name started, and that's what they mean. So for the last few years, let's say after the mortgage meltdown, the only type of reverse mortgage you were able to do is the HECM, okay, like you just mentioned, which is a great product. It's also a HUD product, Housing and Urban Development, I guess, committee or company. And so it required with it FHA underwriting. So the HECM loan is an FHA loan. And I'm going to repeat that. A HECM loan is an FHA loan, which is great, right? It has great, easy to understand guidelines and pretty, standard stuff. Back before the mortgage meltdown, we had other options on reverse mortgages, not just a HECM. And those are coming back now. And that's what I'm excited to talk to you guys about. And I'll answer any questions and I'll go over typically just standard reverse mortgage purchase guidelines. However, we are starting to see the conventional HECM, or let me rephrase that, the conventional reverse mortgage come back. And why is that important to us? Because in South Florida, where we work and live, we have a lot of condominiums that are owned by retired people. And as the FHA guidelines are a little stricter, not impossible, they've gotten easier too. As a matter of fact, we're starting to do more and more FHA condos because, believe it or not, FHA guidelines are a little lighter or easier to get around some of the insurance issues in condos. So the business is interesting. It's full of opportunities. And like I always say, the answers are always depends. There's always gray areas and there's always a solution. But it's our job as, your preferred lenders to help you navigate what's best for the transaction and more importantly, for our consumer. I'll keep going. So, okay. So what is a reverse mortgage? Like I said, it's a mortgage that's backwards, right? Typically on a forward mortgage, you get a loan amount. It's a fixed rate. And as you go, you amortize the loan. And the word amortization means that you're paying down the principal a little bit at a time, right? So the first few years of a mortgage and a forward mortgage, you are paying mostly interest. By the end of the loan, you're paying mostly principal. And at some point, you pay off the loan and the home is yours, right? In 30 years, 360 payments, or a 15-year, or if you make early payments, whatever have you. A reverse mortgage works just the opposite. Your principal balance actually goes up, okay? So you see Tom Selleck pitching these things on TV all day, and I know some people tell me I look a little bit like Tom Selleck, but he's pitching these reverse mortgages. Well, I wanted to be Magnum PI when I was a young kid. I wanted to ride around a Ferrari in Hawaii, but didn't work out for me. But so Tom's out there pitching the reverse mortgage, and and there's some standard guidelines. You do have to be, for example, 62 years of age or older, at least one of the people on the loan. So if you have a married couple, at least one of them has to be 62 in Florida. So for example, every state's a little different. So in Texas, they both have to be 62 or older. And the reverse mortgage does require more equity. So
Okay.
if you came to me and you were 62 years old and you're trying to do it with 10% equity, it's not going to work. You're just basically too young. What's happened is obviously our mortality rates have changed. We're living a lot longer. Luckily, our equity position and the continuation of um, prices going up has helped the process. So right now, we're looking at a sweet spot of about 30% equity, okay, and at least 70 years old. That's where the sweet spot is. That's where somebody's actually gonna really get a great benefit to doing a reverse mortgage purchase. So quite simply, it's like any other purchase. On your side, you're basically negotiating the terms and conditions, and it's an FHA loan or a conventional loan. And what who is this good for? This is good for a retiree or a soon-to-be retiree that wants to move up. Okay. So let's say, for example, they're living in a condo and they want to buy a new home and they have the condo paid off or their home paid off and they want to buy a new home. They want to spend the next 30 years not having to cambiar un clavo, like we say, right? So what we're going to do is we're going to take the equity. So the down payment's going to be, again, for it to make sense, a little more than normal. And they will not make any mortgage payments for the rest of their life. Pretty cool, right?
Okay, run
So
that
let's say,
run that again and slowly because I think a couple of people got left behind on that one. We have a couple. They're 62. They're about to retire, right? And they have a property that is debt free, or they still have.
it doesn't matter. As long
Doesn't
as
matter. Okay.
right, it doesn't matter. The reality is we need 30%, right? And really we need them to be 70. Even though, like I said, Tom Selleck's 62 and he's right technically, but it doesn't work at 62. You got to be maybe 68 and they have more equity. The more equity they have, the more down payment they have, the better it works for them. And what
Okay.
happens is, let's just say they're coming with 50% down, they're 70 years old, and they're buying a $500,000 home. So basically, their loan amount is going to be 250,000, right? They're putting down 250, and on that 250, they will never make a mortgage payment. So it's an unbelievable program for somebody who wants to, again, be able to use more of their retirement income to travel, be able to retire, period, because they have so much equity, right? Ernesto, you said the average American has about 300,000 in equity. Well, if you
Yeah.
take that 300,000 in equity that you just sold a house in Hialeah and you want to, retire to a newer home in Port St. Lucie, this works with no additional mortgage payment. You don't have to worry about it's a fixed rate. Some of the questions that we get, do my heirs get to have the property? And the answer is yes. So it's not like you lose the ability to pass this on to your heirs. And when you're deceased. So it's really a win-win proposition for everybody. And again, the numbers just have to make sense. And the only thing that they have to qualify for, so we know they're not going to have any much income, right? Because they're obviously retired or going to be retired. The only thing that they have to have enough income for, whether it's Social Security, pension, 401k, whatever it may be, is that they have to be able to pay the taxes and insurance on the house.
Okay. Before I bombard you with questions, so everybody listening who's a realtor, they're saying, "Huh? What? What?" The reason that this was part of the topic today is because me and Ruben did a presentation, and I think we were early. I think it was in 2019 called the Silver Tsunami.
Mm-hmm.
And everybody says, "Oh, you're crazy." And I said, "Well, just wait." So in Florida, and everybody hold on to your chairs, daily we have 10,000 people reaching retirement age in Florida. So you got 10,000 people, which means that we have 4.6 million people that will be between 65 and 67, between 25 and 27. We have that's a lot of people that are gonna
Yeah.
retire, right? So the reason that this loan makes sense is because 65, thanks to the advances in medicine, it's not old. You're a young, vibrant person, but now you want to reap the benefits of all your hard work. So it gives you the ability to buy something, put down, 35, 50% down payment, and only worry about insurance and taxes and live that lifestyle that you work so hard for. That's why this class was such an important topic that we wanted to talk to everybody. So if you, once again, 10,000 people in Florida reach retirement age every day, and we have 4.6 million people only in Florida that are between 65 and 67 by the year 2027. So Ruben, who qualifies for this? What are the like? Do you need to have to be a primary home? Do you need to have a credit? Is it like a standard loan application? Or
Yeah.
you just gotta have gray hair?
Well, then I qualify. But
Okay, good.
even though I'm not 62 yet. But yeah, the guidelines are pretty standard guidelines, FHA guidelines or conventional guidelines as far as qualifications. Again, they're not qualifying for the mortgage payment. Let me repeat that. They're not qualifying for the mortgage payment. So they just have to, debt to income ratio just has to be able to show that they can pay for the tax and insurance and that they, were some upkeep of the property. So, one thing that we did learn in Tennessee, and again, it's changing demographics like you were just mentioning, even if they want to, this may be for somebody who wants to continue working part-time, right? Let's say there's, 70, they're still healthy, they don't want to, just um, which is what we're seeing, right? We're seeing people continue to work part-time, do consulting, but they still want to go to Europe for a month, or they want to be able to not worry about a mortgage payment. I think that's the main thing, right? So your typical average mortgage payment nowadays is close to $3,000. I mean, you take $3,000 off your monthly cash flow is huge. So, the reality is they can do this for purchase. They can do this for refinance. We do more on refinances than purchases. But I just think that this program is just pretty amazing, and it goes up to them, on the conventional side to close to $1 million, 800,000 on the conventional, six hundred and
Okay, so then
24,000.
credit is not an issue, right? No credit requirement,
There is credit required, just no income required, or less income
no
required.
income.
Yeah, and again, credit is
Okay.
like it is now, right? The better the credit, the less the rate. Very simple.
Okay. So I always read that and I got a couple of questions. People will go to you guys. So you need to pass a financial assessment. I had read that online.
Mhm.
What is that? Like a medical exam? What is a financial assessment? What is a financial assessment for one of these loans?
So you're going to do a financial assessment. You also do have to have counseling, right? Again, there was a lot of people taking advantage of, again, when we deal with our people of older years or elderly, there's a lot of laws in place to protect them, right? They get scammed a lot. So, and, that's the reason that they want to make sure that they pass, that they know what they're doing, that they're getting themselves into, and also that they, pass the financial assessment, which basically means, hey, we still have enough money to pay the tax insurance, minor upkeep on the house, that kind of stuff. That's what the financial assessment is. In other words, we don't want them to just get it, and not have any extra money, right? Because we know people have to live. So that's what the financial assessment portion of it is. This is something that we pitch directly to the buyers, but many times we bring the family into the conversation too, for many reasons. Number one, they are their heirs, possibly to their property when they become deceased, and sometimes people, elderly people want some advice from their younger offspring. So we do bring them into the conversation.
Yeah. So Gloria has a great question. Banks are great people, great people work in banks, but banks need to make their money back. How does the
They
bank
do.
make their money?
The bank makes the
So
money
good
back when,
question, Gloria.
when the property sells or refinances. That's it. So basically, they're still charging the interest rate. And like I said, it's a reverse mortgage. So if the loan amount's $250,000, right? You bought a house for 500, you put 50% down, your loan amount's $250,000 day one. The interest gets added to that. So the loan amount actually grows. The bank's still going to make their money. They're not going to see it, or they're not going to realize it until either they refinance. You can refinance it too. People don't think you can, but you can refinance out of it. So the balance gets paid. So let's say, I mean, I don't have an amortization table in front of me right now, but let's say person refinances in 10 years and they started with a $250,000 loan. Again, it may be a $300,000 loan, so the bank made 50,000 over that 10 years. And I'm just throwing numbers out there.
Okay. Ro, I think you had a question.
I did, but Gloria beat me to it. I never, good morning, by the way. I never
Morning.
understood how the bank make the money back, and you just explained. But so does that mean that if someone dies at age of 90, and they got the loan at age of 70, then the heirs are gonna be owing probably to the bank instead of getting anything back because of the interest. I didn't know that the interest get add up to it. Um,
Yeah. Yeah. So the heirs at that point have to make a decision, right? First of all, they're not on the mortgage. So if they, in your example, if they live to 90 and let's say the property does not go up in value much, or in other words, they're negative. In other words, they owe, 700 and the property at that point is worth 600. The heirs decide not to take it and the bank sells the property. Bank loses.
So the heirs don't pay it back.
No.
Okay, because
If
that's
they
a
want
misconception.
if they want the property, yes. So for example, if the new accumulated balance of the reverse mortgage is 500 and the property is worth, you know, $1 million, they're going to want the property, right? There's $500,000 in equity. They
Yeah.
don't have to take it, but they have basically they have the right of first refusal.
Okay, so they put 250 down. They were 70 years old. They lived to their 90s. That 250 now was depleted to, let's say, 50, right?
Mhm.
But then over those 20 years, the house that was purchased for 500 is now worth 800, right? So the bank is going to say to the heirs, hey, you owe me 200 grand. You can refinance and pay me out, or we'll take that. So you get the first opportunity.
Right. And I know that we all lived through the mortgage meltdown where prices actually went down. And obviously, if you die during that time, I think your heirs may walk away, right? But most of the time, right, the properties continue going up. So the heirs will make a decision whether they want to buy it. Most of them do. Most of them, refinance it. It's not really a purchase. They just have to pay off the bank.
Okay. Okay. So did that get everybody's questions answered? Because I had a couple of more questions I'm going to throw at Ruben.
so Ruben, technically they need to have then a good credit in order to get a good interest rate. Right?
Well, it's
Like,
an FHA loan, Row. So, I mean, they go pretty low on the interest rates like FHA does. I mean, I guess it's so, but like everything else, yeah, the better the credit, the lower the rate.
so
And
if
it's,
I'm as a heir, right? If I want to help out and buying points for the interest to be low, can they do that? Can the program allows that?
yeah, yes, it does.
Okay, thank you.
It's a regular loan. You're just doing it backwards. I know it's hard to think about it, but the guidelines are very similar. There's some
Yeah,
additional.
you're eating the down payment.
Right. So a lot of people, what they do, what they're stuck, right? They're equity rich, right? And they maybe don't want to live there anymore and they want to move. And this is a way for them to do it without having to really qualify based on their income, which is typically on the downswing at this point, for a property. So again, as long as they, have do financial assessment that they can qualify, to pay the taxes and insurance, what have you, then they should be fine.
Okay, and ladies and gentlemen, if you're saying why would the bank do this, what is their upside or what is the risk? I'm showing you right now a graph going back to 1965, right, of the average median price in the U.S. And if you notice the graph, although there's every once in a while there's a little downtick, right? Every once in a while there's a little downtick. What is the consistent thing? An uptrend. Right. So if I take it down, right, if I take it down to, if I only want to look at the data of this period, even 2090, this is 97 to 98, it keeps on, the graph always moves up. Even if we have the financial crisis downturn that everybody talks about, if you bought at the peak of the financial crisis and you thought you overpaid and you're like, oh my God, I made the worst financial mistake of my life, you know, this is where you are today. So
And
the banks are not, it's not that they're betting, it's that statistically although there are ups and downs in the market, because the real estate market has ups and downs, right? The trend line consistent. I show you 1965 to 2025. The trend line moves up.
Like I said, you just have to, unless you're unfortunate, you get stuck. You live a long time and you get stuck in a down couple of years. But yeah, the trend is very good for the banks. They're going to make money. Banks rarely lose. So that's the reality of it. The main thing though, you're also putting 50% down. It's not like you're putting 3.5% down. You're immediately, you got $250,000 in my example to play with, which is quite a bit. So that's the game. That's the risk they take. It's all risk based.
Okay. Does this apply to condos?
So yes, and that was really when Ernesto texted me or asked me about what I wanted to talk about. Even though we've had this for a while and really don't talk about it a lot, I'm excited about the condos because that's the big change that we have coming, where now we're able to do conventional financing reverse, not just FHA. So again, we would have to analyze the condo like we do on a normal loan. It has to be approved. And no matter what you guys are seeing in the Miami Herald or only in Dade or whatever, listen, guys, we're still doing a ton of condos, a ton. So
If you're
yeah,
getting your news from only in Dade, you need to leave the Zoom right now. You need to leave the Zoom right now because this is no. Trust the sources, people.
Yeah. So yeah, but that's the exciting part for me because in South Florida we have so many retirees that end up in condos or want to live in a condo because they don't want to cut the grass, they don't want to, they like the convenience of it. So now that opportunity, that window is opening up for us to be able to do condos on a reverse mortgage. So the answer is yes.
So, like I said, you got 10,000 people a day in Florida hitting 67. And everybody's not understanding that. 10,000 people are turning 67 in Florida every day. If these people became homeowners and let's say in the 90s, Ruben, right? And they bought a nice little house in Hollywood that they bought at that time for $100,000, the house is now worth 800. They can buy a condo. Let's go fancy. Let's go to the Palace in Weston. They run about 400 grand. They sold their house. They paid everything. They walked away with about $600,000 in cash. They put $200,000 down. They still have 400 in their savings for their retirement. And now all they have to pay is HOA taxes. And I mean, the HOA includes insurance and a condo.
Right.
So that's the only expense they have, and have a nice retirement home that they don't have to worry about, like you said, leaky roof or the lawn or anything like that.
Right. Right. And I know, like I said a minute ago, the condos have got a bad rap, the whole thing that happened in Surfside, all the, but listen, they're not going anywhere. I mean, the reality is this is our market. We have an issue, which is a wonderful thing we have, that we have a beautiful Atlantic Ocean on our east side, and then we have the beautiful Everglades on our west side. There's nowhere to go but up. So the reality is there will be solutions to this. And like I said, we're still doing a ton of condos. I still see that ability. Now, we're also seeing a lot of retirement homes. That didn't come out right. Homes that are being built for people who want to be retired. Okay. You're starting to see price points on the Southwest Florida side where you can, get into a home for brand new home, small, for under 300. You have stuff on the east side and, Port St. Lucie and areas like that. They, if they want a home and not a condo, this still works. So it's really the trend. I am telling you that I've had two agents, one broker and one agent, reach out to me in December that they're only focusing on this market. That's it. The retirement elder market, because of the numbers that Ernesto is talking about.
Well, as a realtor now, how do we use this in a practical way to be another source of business for us in real estate? This being educated in this, and I know that you're probably gonna have a ton of questions. Ruben's gonna put his info at the end, and then you guys can talk to him. But you will be working, a lot of you are going and listing presentations that you'll be, and people are telling you, I'm not ready to move, or what am I gonna do? And I don't know, the house is too much. you'll be working with seniors who are looking forward to downsize, right? And yet don't want to leave the area because they have family. So they want a suitable home for their retirement. So this program will help them. You sell their. It will help you get that listing to sell that, and you'll be able to sell them something. Either I think condos is a great avenue, right? To use this program so they have more cash for retirement in their hands, and they can. So you get literally 2 transactions out of one.
Right.
Right.
Absolutely. I mean, it's a win-win, again, it's a regular loan. And, again, because we're dealing people of older age, they're very cautious. It's very consumer protection driven for us. So at CMG, I'll tell you, at the Prime Group at CMG, you have to be certified. Not everybody can do a reverse mortgage. It's a process. You have to know what you're doing. So again, if you're going to deal with somebody on this, it's very detailed. You have to have the patience to sit down with somebody and their family and talk to them about it in an intelligent financial way. Has to be somebody that understands what the stock market is paying. If do they have an annuity? Do they have a pension? Do they have, it's a bigger financial conversation. But like Ernesto said, now we're talking 2 transactions, not just one.
Okay, I had a couple of things in closing, but I think Ro is super eager and excited with this one. So go ahead, Ro.
Yes. So my other question is, let's say that that my neighbors, I finally convinced her to put it in the market, the house, put it in the market, and she has reverse mortgage right now. I know that you said that it's a regular loan, but is there any payoff, extra fees or anything on this loan that that she'll pay if I put the property on the market once we sell it?
You mean like a prepayment penalty?
There's not a prepayment penalty.
Yes.
Okay.
I mean, well, Ro, when did she get the loan? Did she get it after 2011?
Yes, during COVID.
Yeah,
Funny
no.
story. I tried to convince her to put the property on the market when she was 76. And then COVID hits and, she was forced to leave work and she was still working. And I had to take her to a lender to do it. She did it at the best time. But now I can see that I'm little by little changing her mind about, downsizing because she lives alone in a four-bedroom home. So this is very, like if there is any penalties that I need to, be aware of, or
there
obviously I'll take it to you and then you do the whole explanation, but I kind of want to know.
Yeah, there's not a prepayment penalty. So just so you guys know, in the United States, on your primary residence, it's illegal to have a prepayment penalty. You can have it on investment property. Okay, so there's no prepayment penalty, Ro. Other fees, I mean, I have to look at the documents. Probably not.
Okay.
But, that's maybe more of a question.
Okay,
for
so that
Michelle.
was the other question. So there's no, if someone takes out a reverse mortgage and then 2 years from now, either the situation or health changes and they want to sell the property to go somewhere else, there's no restriction paying off what you owed, right?
Nope, no restriction. I will tell you, like everything else, we sit down with the customers and we plan. If they're only going to be in the property for an additional 2 years, it's not worth it. This is more somebody who's going to be in, actually the magic number is 2 years, more than 2 years. So if they're thinking, well, I'm going to be in this property for 2 years, then I'm going to go move to California to help my daughter raise the grandkids, this is not worth it. But if it's more than 2 years, it's definitely worth it. Now, we never know how long we're going to live, right? But that you still have to have that conversation.
So until AI figures that out, Ruben, we're good. So Saji was asking if there was any other programs. I mean, there's HELOCs. There's a lot of other things, Saji, that maybe you and Ruben can chat when he's in Weston next time. But there's other couple of things. So wrapping it up, who is this good for you guys as a realtor? Like, who is the candidate? So is when you're going on those listing appointments or you're talking to prospective sellers, you're looking up for, the age, which is 67 to 70, looking to downsize, right? Primarily looking for low maintenance community. Convenience is key, doctors, family, general services, right? Someone who doesn't need all the cash from their sale because they're going to have put a substantial down payment, right? So those are the the keys. Someone who their house doesn't fit the lifestyle. You may come encounter for somebody who has a large house, a large yard, and just their physical needs is not going to let them maintain that anymore, right? So this gives them the ability to increase substantially their purchasing power by putting more down, and like I said, retire in style. Ruben, this was a great topic. I think that we might have to do this one again because there's I don't think I don't think we all grasp it yet, but based on those stats that I looked up when when we talked about this, I think South Florida has and I looked at a specific area of Dade County where there was about 22% of homeowners that are over 76 and almost own their houses free and clear, and their houses have become a trap because they can no longer maintain the house, the insurance, the roofs. So there's a great tool for realtors to use, and at the same time make a commission out of it. But you'll be bringing a great service to it. So we might talk about this again in another one of these. Best way to anybody that has any extra questions that want to reach out to you.
So my cell phone, and again, I'm really good about calling everybody back. Leave me a message or text me, 954-661-2790. Real quick, Saji, the HELOC program on the reverse mortgage is amazing. It's better than the purchase, to be honest with you. It's amazing. And the last thing, guys, is, we're thinking about people downsizing. What we're seeing also, people, is that they're bringing in, again, more traditional families living together where only the grandparents can have the down payment or can apply for the mortgage. So we're seeing that too. They're actually upgrading homes to bring in their daughters and sons and grandkids to live with them. So it's not just a down payment.
No, it's not. No, it's not. I mean, they could sell their little 2-1 in Westchester for $800,000 and buy a brand new house for half the price in Port St. Lucie and have 5 bedrooms, 3.5 baths, and then now they can have, they have the family around them, they have care around them. So it's all a win-win situation. Ruben, thank you so much for doing this. Thank you for everybody that participated and asked the questions, because that's what keeps these things lively. We will be back again next week with another interesting mortgage-related topic. 2025 is going to be your year if you're listening to us today. Have a great rest of your week and see you guys around.
Bye, guys. Thank you.
Bye-bye.